progress.
Good afternoon, everyone. A very warm welcome to each one of you to another insightful session in the Brain Gain Expertise series, proudly hosted by the Accounting Standards Board of the ICAI. We are pleased to have you with us for an in-depth exploration of a vital topic, cash flow statements, classification and disclosure issues. This 13th webinar in the series reaffirms our dedication to empowering professionals with knowledge and clarity on key accounting topics. Today's discussion is designed to provide you with insightful practical issues and illustrative examples on the classification and disclosure of cash flows in financial statements. The session aims to help you address common challenges, improve the quality of disclosures, and ensure consistency and compliance with applicable accounting standards in the preparation and presentation of cash flow statements. We are privileged to extend a very warm welcome to our esteemed speaker for the day, CA Kaleshwara Prasad ji. Thank you for joining us, sir.
Thank you. It's a pleasure.
Let me allow to briefly introduce our moderator for today's webinar, CA Meenal Khemka, ma'am, before we move into the technical session. CA Meenal Khemka is a qualified chartered accountant with over 9 years of post-qualification experience. She is also a DISA qualified professional from ICAI with over 6 years of expertise in information system audit. She is well versed in handling both corporate and individual taxation, ROC filings, and providing end-to-end financial and regulatory support for businesses. With this, I would now request Meenal ma'am to address the webinar and give a brief introduction of our speaker for today, CA Kaleshwara Prasad ji. Over to you, ma'am.
Thank you, sir. Good afternoon, everyone. Let's have a brief introduction of our speaker, CA Kaleshwara Prasad. He is a law graduate from Karnataka State Law University and information system auditor from US based and have done diploma in international financial reporting. He has more than 20 years of experience in the field of financial reporting, auditing, taxation, and consultancy work. He is a founding partner of KSK and Company, Bangalore-based CA firm looking after audit, financial reporting, and taxation matter. He has rich work experience with Deloitte and Touche with South Africa. He is visiting faculty of ICAI and a speaker at ICAI webinar. Apart from this, he is technical reviewer with the Financial Reporting Review Board of ICAI. Now I request to our speaker to start their session on the topic of cash flow statement, classification and disclosures issues.
Yeah.
Sir, please start your session.
Thanks, Meenal, for this introduction. I would like to thank Accounting Standard Board, the torch bearers, and the support staff for giving this opportunity. Okay, so if you could help me to share my screen, please.
So there's an option in the bottom, share screen.
Yes, is my screen visible?
It's visible.
Unlike a traditional way where I'll take you through the PPT, so let me share the Excel sheet with few questions so that it becomes easier for me to deliberate on this topic. Whenever we talk about a cash flow statement, whenever we understand, so we have been doing this under accounting standard. So under Ind AS, the corresponding standard is Ind AS 7. Okay, so the first question which comes to our mind is, in Ind AS, when you are preparing a cash flow statement, is cash flow statement a mandatory or an optional? If you recall, or if you are able to recall the accounting standard regime, under certain circumstances, preparation of a cash flow statement becomes optional. Say, for example, for a small companies, for a dormant companies, you have an option of not preparing the cash flow statement. However, in Ind AS regime, you do not have that option where it is every time, whenever you're talking about a financial statements, cash flow statements have to be mandatorily presented. Whether it is interim financial statements or a standalone financial statements or a consolidated financial statements, The moment when we say it as a cash flow statement, the moment we say it as a financial statements, the cash flow becomes an integral part of those financial statements. Okay. The other general question which comes to mind is fund flow. We have a cash flow on one side, we have a fund flow. A quick explanation as to what the fund flow could be. Fund flow is basically, it's a generalized presentation wherein we present the movement between current assets and current liability, how the movement has happened in the current assets and current liability, wherein we don't just restrict to actual, we even take into account the accrual of it. However, in cash flow statement, we take into account the actual movement and we don't take into account non-cash items. So that is the interesting differences between cash flow and a fund flow statement. Cash flow, Ind AS 7. So with this background, let us start with Ind AS 7 cash flow statement. One of the interesting aspect in cash flow is my cash and cash equivalent, which is a basis. Basically, what the standards expect us is, it expects us to ascertain what is your cash and cash equivalents and prepare a reconciliation. When I come to a disclosure, I'll deliberate more on this. Cash and cash equivalents. So the definition remains almost similar to what we would have learned in accounting standard, but let us revisit and understand what are cash and cash equivalents. Cash and cash equivalents are short-term, highly liquid investments. These are short-term, highly liquid investments, which can be converted to known amount of a cash, and which is subject to insignificant risk of change in value. Let us understand each one of it independently, because when we say cash and cash equivalents, all the four conditions what have been mentioned here has to be fulfilled. What is short term? So short term is basically which has a maturity of less than 90 days, 3 months or less. So the question is, how do I compute this 3 months? How do I take this into account 3 months? The 3 months have to be evaluated considering the date of investment. I'll give you two simple examples. I have an investment which is made. So presuming that we are talking for a balance sheet as on 31st March 2025, I'll take two instances. I have an investment which I made it in the month of November 2024, which has a maturity of 6 months, Okay. And I have one more investment which I have made it on 29th March 2025, which has a maturity of say 3 months. Now, even though the investments which have made it in the month of November 2024, which is going to expire say by May 2025, the other investments which have made it in March 2025, which will expire 2025, which may expire say in June 2025 to expire. If you look at this, the first investments, even though it might mature earlier from the balance sheet date, this will be excluded from the cash and cash equivalent. Basically because the short term, the criteria what they have put in is taking into account the original date of investment. That means investment should be able to mature. It's a short duration from the original date of investment, not from the date of balance sheet. Very interesting criteria. So in this case, even though this first investments, which has a lifespan of 6 months, going to mature within 2 months from the date of balance sheet, this would be excluded or not be considered as a cash or cash equivalent. The other investments, which is going to mature, which has a original maturity of 3 months, so that could be considered as a cash and cash equivalents. One common question which comes to mind is, I make an investment for 3 months, And every 3 months, I keep on renewing it for a further period of 3 months. So in this case, can we consider it as a part of cash and cash equivalents? Let me repeat my question. When I say short-term investments are those which has a virginal maturity of 3 months or less. The question what I have is, I have management has made an investment with a virginal tenure of say 90 days, and every 90 days they keep on renewing it. So can we consider that as a part of my short-term cash and cash equivalent? The answer is no. The answer is again dependable. So let us not blindly get into the yes or no type. Let us go behind the reason. What was the intention of the management when they originally made the investment? Was their intention is to keep on renewing so that as and when they have an opportunity to exhaust or utilize the fund, or their intention is just to park for a short term and then utilize? In the second situation, their original intention was just to park for a short period of time and wanted to utilize in some investment avenues. It so happened that that investment avenue got postponed. That is how they renewed it for another such period. So in that case, it can very well form part of my cash investment, because the original, when they made the investment, the intent of the management was not to renew it. However, subsequently, if they renewed, so that is purely like the further thing. However, if the management intent is to just keep the money and they know that after 3 months, again, they would like to reinvest, again, they would like to renew, then that might typically not fall into short-term criteria. So having understood the short-term criteria, which clearly says the virginal maturity period have to be considered, let us move on to the second interesting thing. The second interesting thing to qualify it as a cash and cash equivalents are the cash and cash equivalents have to be highly liquid investments. That means I should be able to convert it into cash. I should be able to readily convert it to cash. So moving on further, the second condition gets further tested when it says that you need to convert it to a known amount of a cash. It should be able to convert it to known amount of a cash, and which is subject to insignificant risk of change in value. Let us understand together with a very simple example. An entity has invested, the management has invested, say it has a surplus funds and it has invested in an equity investments. Okay, so equity investments, as we know, even though their intention is to park the funds in a equity oriented mutual fund and they want to withdraw, say 45 days or 50 days down the line, that may ideally not ideally not fulfill the condition, because it is subject to change, subject to market fluctuations. Those I may not have to consider. Those might be excluded from my cash and cash equivalents. It will still be my current assets. I'm not disputing that I will not be taking it as a current assets. My only thing is, do I take it as a cash or cash equivalent? Investments in a short-term investments, which are equity or such equity oriented, might not fulfill the condition. However, similar investments, I have made similar investments in a preference shares, which is going to have a maturity in say 45 days, and I know what is the amount I'm going to get in relation to those investments, then that could fulfill, or that could form part of my cash and cash equivalents. To summarize, to understand cash and cash equivalents, let us understand this. It has to be a short term in the sense the virginal duration of the investment should be less than 3 months. The maturity period should be less than 3 months. This should be highly liquid. We should be convertible to known amount of a cash and subject to insignificant risk of change in value, small risk in change in value. So this was what was there even in our accounting standard 3. This was what was there even in accounting standard 3. The definition is not undergone a change. Continuing this, I'll take one additional example. There are various other examples which I normally take. So there's one additional example which I would like to take. I had extended a loan. So on item number 8, I have extended a loan to a party, to a customer, to help in managing the party or a customer short-term liquidity position. Let us read this question again. I've extended a loan. The entity has extended a loan. The loan could be for a 60 days. Okay, the loan could be for a 60 days. The customer is a financially creditworthy. That means I'm sure that I'm going to get a money back in 60 days. Okay, but the objective is to meet the party's short-term liquidity position. The question is, can I classify this as my cash and cash equivalents? Let us evaluate this. Is it a short-term? Yes, my intention is for less than 60 days, so less than 90 days, it fulfills that. Highly liquid, I'm sure that this is for a period of 60 days and is going to repay that money back to me. Is there any risk of change in value? So presuming that having given the financial background of the customer or the thing, so there also it fulfills the condition. Can I conclude that the loan what I have given for a short duration, will it fulfill under cash and cash equivalent? The answer is no. We have to read the cash and cash equivalent with para 7 of Ind AS 7. Para 7 clearly says that my cash and cash equivalent should be to meet my short-term cash commitments. Entities short-term cash commitments. So its objective is to manage the cash positions or cash commitments, not for third party. In the given example, the objective is to fulfill the third party cash commitments, not the entity's cash commitments. Accordingly, this may not fulfill or this may not become the cash and cash equivalent. Okay, so we'll have to read the cash and cash equivalent definition with para 7. That means it has always have to be with the intent to fulfill the entity's cash commitment, not for any other intention. So it has to fulfill the short-term cash commitments of the entity. Okay, so some of the classical examples are treasury bonds, okay, fixed deposit with a duration of less than 3 months, investments in redeemable preference shares, as I told you, with a clear understanding that it's for less than 90 days and I'm sure to get a certain sum of money because, as you know, redemption criteria would have been clearly mentioned. So those could help me, or those could help us to classify this as a cash and cash equivalent. The common question which most of us have is, what about bank draft? What about cash credit? Do they fulfill or can I classify them as a cash or cash equivalent? Okay. Accounting Standard 3 had made, it was silent basically. It did not give a required explanation as what we have in Ind AS 7. So Accounting Standard 3 was silent. So basically, whenever I have a bank overdraft or a cash credit facility, I used to classify them as my financing activity. I never used to consider as a part of my cash or cash equivalent. However, Ind AS 7 goes a step and tries to explain that if a bank overdraft is of such nature that it is repayable on demand. So the moment we say repayable on demand, the duration is short. That's the first requirement. The second requirement is the intent of the management. The management intent to go for a bank overdraft is to manage its short-term cash positions. That means if you look at the overdraft facility, it would be like a spike. I will have a surplus, I will have a deficit. The moment there is a deficit, I will repay, I will ensure that it comes to a surplus, and only in case of a requirement, I will overdraw the facility. So in this kind of instances, bank overdraft might be considered as a cash and cash equivalents, Okay, this kind of a explanation was not there in accounting standard, and in accounting standard we used to generally classify bank overdraft as a financing activity. However, in Ind AS 7, cash and bank overdraft would very much form part of my cash and cash equivalent, provided these things are fulfilled. What are those conditions? It is repayable on demand. That means it is of a short duration, and the intent of the management is to use it for its cash management or its short-term cash management thing. And if you look at the position, it is basically surplus, and only in case of a thing, it is overdrawn and the balance becomes negative. Okay. Coming to the cash credit. Can we extend the same thing for a cash credit facility? Cash credit is basically a loan or a facility being provided to mitigate your working capital requirements. Okay. Ideally, cash credit will be of a continuous basis, and cash credit, since it is to mitigate, and most of the time, if you see that you do not see a surplus or a negative, most of the time it will be overdrawn, and the intent is to manage the working capital position. So accordingly, cash credit do not fulfill or do not become part of my cash and cash equivalents. It will be a part of my financing facility. So let me revise what we have understood. Bank borrowings are ideally, generally, or financing activity. However, if there is a bank overdraft, and if the intention is basically to manage short-term cash position, and it is the nature of repayable on demand, and if you look at the nature, it is surplus as well as a negative. In that case, those bank overdraft could be taken as a cash and cash equivalent. The contrary, the cash credit normally do not fulfill this requirement, and cash credits would generally be grouped or considered as my investing activity. Okay, so we have done the first level of understanding as to what are cash and cash equivalents. Cash and cash equivalents are short-term, highly liquid investments convertible to known amount of a cash, which is subject to insignificant risk of change in value. And most importantly, read with para 7, which clearly says that is to meet your short-term cash commitments. If all the conditions fulfill, then that is going to be your cash and cash equivalents. A disclosure: what constitute a cash and cash equivalents is your accounting policy. Okay, so if at all, say there are short-term investments, and if you're changing the short-term investments, previously it was grouped as financing activity, and now you want to take that as a part of your cash and cash equivalent, you have to be very, very careful, because that could tantamount to change in accounting policy. What constitute cash and cash equivalents is a accounting policy. You have to be very clear as to how you are complying with your accounting policy in terms of ascertaining or arriving at a cash and cash equivalents. Okay, so having covered the first aspect, let us see how do you prepare your cash flow statement under Ind AS. The methodology is same as what we were preparing under accounting standard. Okay, we have two possibilities: possibility of direct method and indirect method. Direct or indirect method are basically only applies to our operating activity, and investing and financing activity, we generally go with the direct method. So having said having been talking about operating, investing and financing, let us understand what are operating, investing and financing. Again, I'll try to keep things simple for us to understand. If I basically look at my balance sheet, I can group my overall balance sheet. I can group my overall balance sheet into following things: liability and an asset. Asset, again, at a very high level, I can group it as a non-current assets, which will have a property, plant and equipment, long-term investments, long-term assets, etc. And then I have a current assets. Current assets are those basically as defined in framework, one which has a maturity of 12 months from the date of a balance sheet. So those are current assets: your inventory, your debtors, your bills receivable, your short-term assets, all that will fall into current assets. On the liability side, again, I'll extend the same explanation. I have a current liability, I have a non-current liability, which, okay, current is anything which has a duration of 12 months or less, and non-current liabilities which becomes repayable after a period of 12 months from the date of balance sheet. And in addition, I have something called as equity and shareholders fund. So basically a shareholders fund. Okay. For a cash flow statement, we group this balance sheet into three possibilities. Any changes in current assets, when I say changes, that means it might give rise to a cash balance or it may consume my cash balance. Anything which give rise to or consumes in current assets and current liability. So we group that, or we call that as an operating activity. What are operating activity? Anything which recognize the change in current assets and current liability is my operating activity. It is grouped as an operating activity. Continuing the same, any movement in non-current assets. If I have purchased a property, plant and equipment, if I have sold a long-term investments, any such movement in the non-current asset will be grouped as an investing activity or will be called as an investing activity. Now, having sorted out what is that which is pending, the thing which is pending is shareholders fund and non-current liability. Any movement in equity and non-current liability will be grouped as my financing activity. Okay, that means whenever there's a movement in current assets and current liability, I consolidate that, I group that and call it as a cash flow from my operating activity. Same thing with respect to non-current assets, equity and non-current liability. I consolidate, I group, and I present that in one go and call that as an operating, investing and financing activity. Let us summarize this. What are my operating activity? Any change in current assets or current liability. In other words, what are current assets and current liability? Basically, my revenue generating avenues. Any such thing which are basically helping in my primary revenue generating activity, that will be grouped as an operating. Anything which is basically non-current assets, that would be my investing, and anything which is in relation to non-current liability, equity and other and shareholder fund, that will be my financing activity. Okay. There is one interesting element, because I would like to, I'll come back to this again. In addition to the change in current assets, current liability, in addition to those which basically facilitate primary revenue generating possibility, anything which cannot be grouped under investing and financing will fall under operating activity. So this is interesting, which we'll understand why it is so at a later point of time. So any residual in nature, if you're not able to group in particular as to a investing or a financing activity, you may come back and group that as an operating activity. Okay. So operating, investing and financing Having understood this operating, investing, and financing, let us see how do we actually prepare a cash flow statement. So cash flow statement from an operating activity could be prepared under direct or an indirect method, could be prepared under direct or an indirect method. All others, there is only one possibility of direct method. So let us understand how do I prepare cash flow statement in case of a direct method. Okay, in a direct method, it's also called as a top-down approach. We call that as a top-down approach. I would basically try to see the revenue, cash generated from my revenue activity. When I say cash generated from my revenue or a sales, I would even take into account the sales and the movement which would have happened in data, the movement which would have happened in data. So that is where we stress and ascertain, or we stress and say that these are cash sales or a cash from revenue activity. All that we will try to ascertain and provide that. Same way with respect to the purchases. With respect to the purchases, we will identify only cash purchases, including the movement in if I have paid anything for stock, which I've paid something. So all that would be an outflow in relation to our operating activity. Then I will take into account only the operating expenses, only the operating expenses. Then what I get is a operating profit. And then from that, I will reduce my taxes. Then what I get is a net cash from operating activity. I will give few examples as to what are operating and what are non-operating after this explanation. Just allow me to continue, and then we will come back and see this. I'm only trying to explain you direct method. Direct method is basically a top-down approach, wherein I would have started from my ascertaining the cash inflow from my operating activity. What are my operating activity? Primary revenue generating activity. Then expenditure in relation to primary revenue generating activity. And then what I get is a profit. Then I even have, if at all I have to pay any taxes, I will have to reduce that. Then what I get is a cash flow from my operating activity. The same thing can be presented in an indirect method. Okay. So in this, what we follow, it is also called as a bottom-up approach. Wherein I will look into my profit or loss for a given financial year. And then I will add back my profit, because I'll tell you what is a presentation in relation to taxes. I basically have to show the taxes separately. So that is an interesting thing. So that is where I will just add back my profit. In case I have any other items, what are those other items? Say, for example, if I have an interest received or an interest paid, which typically is not in relation to my operating activity, I would adjust for that. I'll also adjust for non-cash items. Say a simple example, a depreciation or a bad debts written off. Those kind of a non-cash item also gets adjusted. Then what I get is a operating profit from work. Operating profit. For that, I need to make changes in relation to working capital. That means I'll go to the current assets and current liability. I see whether those current assets and current liability, are there any movement in cashes, and accordingly I group that and arrive at my cash from operating activity. Then I show my taxes. Then I ascertain my net cash from operating activity. Okay. Only the operating activity, the presentation, I may follow the direct method or an indirect method. But for all others, I follow a direct method. An interesting thing is most of us might be following an indirect method. Most of us might be following an indirect method for one or the other reason. But any thought as to what method the standard prescribes or what method the standard suggests. If you go back and check the wordings of Ind AS 7, Ind AS 7 says for operating activity, you could follow either the direct method or an indirect method. Okay. And it further says that direct method of presentation provides more information to the readers of financial statements, and this could be given a preference. In case if you are wanting a reference, then direct method gives you a more better method of presentation of financial statements, and the standard says you could follow direct method. Otherwise, there is nothing like first or second. As a passing reference, it says this gives you a more comprehensive information to the readers of the financial statements. That is where direct method could be followed. Otherwise, both the method could be followed, and most of us practically we follow the indirect method. Okay, so before I move on to investing and financing, let us just come back and see some of the examples for operating, investing, and financing activity. So here we will try to understand. As we said, primary revenue generating activity, anything which revolves around my primary revenue generating activity. So that is going to be my operating activity. That is going to help me to ascertain operating activities. So for a bank or a financial institution, their primary revenue generating activity is basically lending, borrowing, earning interest, and paying interest. For them, the application would be slightly different. For a non-banking or a non-financial institution, for us, the sale or services would be our primary revenue generating activity. Lending or borrowing could be only incidental to the primary generating activity. So the grouping of operating and non-operating items would vary. So for the discussion purpose, I will take an example of other than financial institutions, so it becomes easier. These are basically the explanation. What we are going to have now is taking an example of an entity which is other than bank or a financial institution. Okay, if I'm paying an interest, so please note that if I'm paying an interest is basically paid in relation to the amount what I would have borrowed. The amount what I would have borrowed typically would have been my financing activity in the balance sheet. If you're able to recall, shareholders fund, long-term borrowings. So accordingly, okay, interest received on loan, interest paid on deposit would be financing activity. Since I'm paying an interest, that would be my financing activity. Okay, that would be my finance. Yes, sorry. That would be my financing activity. Same way, if I'm receiving an interest, if I'm receiving an investment, why I will receive an interest? I would receive an interest because I've made a deposit or I made an investment. So accordingly, that becomes my investing activity. However, if this were to be a bank or a financial institution, okay, so this would invariably grouped as an operating activity. This would have been invariably grouped as an operating activity. Okay. So that is where this becomes important. Primary revenue generating activity is what we'll have to keep in mind to establish or to group the operating, investing, and financing activity. Okay, I will not dwell upon too many line items. Let me just go into only the important aspects of it. If I'm receiving a commission, in case of if I'm a regular thing, then that's going to be an operating activity. So moving on to an interesting aspect which we will have to understand, lease rentals. paid. An entity is paying a lease rentals to various branches. Okay. So now please help me whether it's an operating, investing, or a financing activity. Whether it's an operating, investing, or a financing activity. One thought or one conclusion which generally comes to our mind is, since I'm paying a lease rentals in relation to office premises which I have taken, in which I am running my business, So this lease rentals what I pay should or may be classified as an operating activity, would be classified as an operating activity. Are we correct if we say that this is an operating activity? Let us go back and check the requirement. So we'll have to draw a reference to Ind AS 116. Ind AS 116 talks about lease accounting. When it talks about a lease accounting, it provides you an accounting in the books of a lessee and a lessor. It provides a accounting treatment in the books of a lessee, in the books of a lessor. Lessor is basically owner of the asset. Lessee is basically a borrower of the asset. Okay. Please note that I'm explaining this again. Under Ind AS, unlike our accounting standard, there is a drastic change when it comes to an accounting for a lease in the books of a lessee. In the books of a lessee, there is no difference as to what the operating lease and a financial lease. The accounting treatment in the books of a lessee, there is no difference as to operating or a financial lease. That means all the leases, unless they have one or two exception, that's it's of a short duration or it's of a less rentals, only in those circumstances they can treat that as an expenses, charge it to the P&L account. Otherwise, the lessee have to invariably follow what we would have otherwise followed for a financial lease. That accounting is what a lessee has to follow. That means lessee has to invariably recognize a lease liability and a corresponding ROU of an asset. He has to recognize lease liability and ROU of asset. Okay. So that means at any given point in the books of a lessee, unless he chooses those exception, what are those exception? If the lease duration is for a small period, if it's for a short duration, which is less than 12 months, or it is for a less value assets. Lease rentals itself is for a assets which is of a comparatively smaller value, then only in that circumstances I may take that as an expenses and push it to the P&L account. Otherwise, I invariably have to ascertain what is going to be the total rental payment in relation to the leases and recognize that as a lease liability and recognize a corresponding asset on the asset side, So once I recognize a lease liability, so please note that that would get classified as a financing activity. To answer the original question, the lease rentals being paid would invariably get into financing, will invariably have to be provided as a financing activity, not as an operating activity. That means in the cash flow, from the lease rentals, I'll have to bifurcate how much is the interest portion, how much is the principal portion, how much is the interest portion, how much is the principal portion, and show that separately as financing activity. Okay. Hope this is understood. This is a drastic. So in accounting standard, I might have applied my operating and financial thing and then the understanding would have been different. However, in India AS 7, lease rentals are typically grouped as or presented as a part of your financing activity and not as an operating activity. Extending the same, how will lessor recognize the lease rentals? How will the lessor recognize lease rentals? Does he have to recognize this as a financing activity or receipt on account of a financing activity? The answer is no. The accounting for lessor is the same as what we have in lease accounting and accounting standard. The lessor has to account this based on whether it's an operating lease or a financial lease. Operating lease or a financial lease. And accordingly, if he is receiving lease rentals on account of an operating lease, then that lease income, you will recognize it as an operating activity, income from operating activity. And if he is receiving on account of a financial lease, then that he will recognize as a revenue, or that he will group it under investing activity. Are we clear? So please note that lessor is the owner of the asset. He is getting an income. He is getting an income. The accounting treatment as per the lease accounting, he is required to group the lease accounting into operating lease or a financial lease. And accordingly, if he is receiving a lease rentals, if it is an operating lease rentals, he will recognize it or group it under operating activity. If he is receiving lease rentals on account of a financial lease, he will show that as its investing activity because that is an income inflow for him. Needless to say, he has to bifurcate the interest and the principal and show it separately. Okay. So this is an explanation with respect to lease thing. There are one or two additional things, then I'll move on. An entity has purchased a vehicle for its key managerial person, okay, in exchange of swapping the old vehicle. Okay, say there was an existing old vehicle which it swapped, and by paying an additional 3 lakh rupees, they happen to buy a new vehicle for its key managerial person. The thing is, 3 lakhs of cash outflow has happened during the year. Where should I show? I invariably have to show it as investing activity because this is in relation to acquiring of an asset. Yes. Now coming to the disclosure with respect to taxes, we'll understand that. Then I'll go back to operating, investing, and financing again. Coming to the taxes. The standard says that, okay, unless you are able to bifurcate the tax outflow, into financing or investing, you can group that as an operating activity. What is the first requirement? If you are able to ascertain the taxes in relation to investing or a financing activity, you can group that as an operating activity. Let us take simple examples before we move on. I'll take goods and service tax, which entity have to pay after adjusting its input tax credit. I take capital gains on sale of, say, a building. Okay. Capital gains on building, if at all it is sold, it is subject to capital gains. So capital gains. And then I have a income tax in relation to my operating profit. So 3 examples to understand. Goods and service tax, basically these are in relation to my revenue generating activity. So this would be my grouped or shown as a part of my operating activity. Okay. Capital gains on a sale of a building. Building is my investing activity, and this taxes also in relation to sale of a building is to be shown as investing activity. Your regular income tax, what you pay, in relation to your purchase and sale or the revenue profit what you have earned. So that will be grouped as an operating activity. Okay. So with this background, let us see what the standard requirement is. The standard, what it says is the taxes, unless you are able to bifurcate it clearly as to your financing or an investing activity, you can show that together as an operating activity. So this is the first thing. What is the first thing? If you're not able to bifurcate, and then show it as an operating activity. Show it as operating activity. If you are able to bifurcate, so you know that capital gains tax is in relation to sale of a building, you are able to ascertain the value properly, then you will have to show that as a part of your investing activity. And toward the end, you will have to show some total of taxes being paid during the year. So you will have to show some total of taxes paid during the year in one disclosure. So this is ideal because I might have shown my taxes payment in the operating, investing and financing activity. The standard expects you to show the sum total of taxes what you have paid during the financial year as a presentation. Again, the additional thing is the taxes, whenever you are showing or there is a tax payment, the taxes will have to be shown as a separate line item. Will have to be shown as a separate line item under the respective grouping, group. Okay. So if it is an operating activity, investing activity, or a financing activity, the taxes will have to be shown. You cannot just club that and show it elsewhere. You will have to show that separately under the respective grouping. Okay. So this is in relation to the presentation of taxes. I have one more interesting thing to say in relation to this. We have taxes. So one is income taxes. Then if you're paying taxes late, then you have something you will have to pay interest on taxes. Yeah. If I pay normally, I'll pay only the taxes. If I don't pay it on time, then I'll have to pay interest on taxes. Again, there could be a penalty. Which I may have to pay. Okay. So the question is, so the taxes, again, for understanding purpose, the taxes in regular course of a business, you may have to pay interest in relation to that. You may also pay penalty. So this is one thing. The other thing is, if you have paid excess, you will get a refund of your taxes. In addition to refund, you will also get interest on tax refund. And I don't see any corresponding word for penalty. So these are the receipt side of it. And these are the payment side of it. Okay. Now the question is, income taxes, it will be grouped as an operating activity. Yes or no? It will be grouped as an operating activity. Where will you group interest on taxes? So please note that if you were to pay under normal circumstances, you would have paid only income taxes. Okay. Since you have not paid it on time, that is the reason you have to pay interest over and above the principal amount. So since you are paying over and above the principal amount, so this is more in the nature of a financial arrangement. And the interest, if any, will have to be shown as a financing activity. Will have to be grouped and presented as a financing activity. Am I clear? Income taxes, I would have definitely, if presuming that it is my regular income taxes, I would have shown it as an outflow on account of an operating activity. if I have to pay interest, that since this is only on account of a delay in payment, why there is a delay because of a delay in payment, I've been asked to pay an additional interest. So interest on taxes could be grouped as a financing activity. Coming to the refund of the taxes what you have paid, again, it's an inflow to be recognized as an operating activity, If you're getting an interest on income tax refund, again, refund was with the department, and since they did not pay it on time, so you are getting a interest in addition to the original refund. So that could be grouped as a interest received on income tax refund could be grouped as an investing activity. Okay. What about the penalty? Again, in a simple way. So all of us were struggling to upload the tax returns. Yesterday it had not happened for one or other reason. They have extended one more day. So in either way, say presume that something which you did not fulfill what you are expected to fulfill. Because of that, you have been charged a penalty. Where should I group it? Should I group it as an operating activity? Okay. Should I group it as a financing activity? Or should I just ignore this, subgroup it and as something else? Okay. So this is where the thing comes. When we were understanding operating activities are those which are primary revenue generating activities. And we also said one which are residual in nature. And accordingly, so this could be grouped as an operating activity, outflow on account of operating activity itself. Let us have a quick revision as to presentation of taxes. We are not here to compute the taxes. We are only here to say how the taxes would have to be shown in cash flow statement. In a cash flow statement, the requirement is the taxes will have to be shown separately as a separate line item under each of the respective grouping, whether it's an operating, investing, or a financing. You will have to group that separately and show it accordingly. So this is the first thing. So there is nothing called clubbing of thing. It has to be shown separately. The next interesting thing is, if you are able to bifurcate the taxes in relation to whether it's an operating, investing, or financing, you are expected to show that under the respective grouping separately. However, you are also expected to show what is the sum total of tax liability or taxes what you have paid by way of a disclosure. Okay. So those were the requirement in relation to taxes. If you're not able to bifurcate, then those taxes can be shown as a part of your outflow from operating activity. Coming to the taxes, interest, and penalty. So taxes will basically take the color of its parent. So if it is taxes paid in relation to investing activities, then it would be investing taxes. Tax outflow will have to be shown under investing activity. Taxes, if paid in relation to operating activity, will have to be shown as an outflow in relation to operating activity. However, the interest, what you pay over and above the taxes because of delay in payment or a delay in receipt in case of an interest on income tax refund. So those could take the nature of a financing activity if it's an outflow, and an investing activity if you are receiving an interest on delayed payment of refund. The penalty, if any, so that would ideally go under the grouping of an operating activity. Okay. So in this background, let us come back and recheck our understanding with respect to operating, investing, and financing activity. What are my operating, investing, financing activity? Anything which is in relation to my primary revenue generating activity would be my operating activity, invariably most of the items in my profit and loss account and most of the items in my current assets and current liability. Okay. Anything in relation to non-current assets, that will be grouped as an investing activity. Anything in relation to equity and non-current liability, that would be grouped as a financing activity. So the inflow and outflow in relation to this will have to be ascertained, will have to be provided separately under each of the groupings respectively. This will also help us to ascertain if taxes are paid in relation to that. That will have to be shown as a separate line item under the respective head. Okay. Only for an operating activity, the standard gives you two alternatives. Either you could follow a direct method or an indirect method. The standard, even though it does not mandate, it only suggests that direct method of presentation is more beneficial because the readers of the financial statements can get a comprehensive meaning if a cash flow statements are presented under direct method. That's what it says. However, in general, most of us prefer indirect method of presentation of a cash flow statement. So direct method, indirect method. So we have dealt it earlier. So indirect method, we also call it as a top-down approach. We call it as a top-down approach. The total cash inflow, total cash outflow from my revenue generating activity alone, I would take into account. In that process, if I have any non-operating or non-financing activity, I would have totally ignored. Then what I get is a net cash or a cash from operating activity, net cash from operating thing. For that, if I have any taxes which I have paid, that will have to be shown separately. So that will help me with the net cash from operating activity. Coming to the indirect method, which is a bottom-up approach, where net profit or loss for a given financial period or a given accounting period becomes a basis. For that, I will invariably add back profit. The only reason is that profit will have to be shown separately. In the P&L account, if you have noted, there will be various non-cash items, various non-operating items, non-cash depreciation, debt, bad debts written off, those kind of a thing. Non-cash items like your depreciation. Okay, non-operating items, please pardon me, non-cash items are your depreciation, bad debts written off. Non-operating item are basically interest received, okay, which in interest received or interest paid, those kind of a thing, which would have to group into the investing or financing activity as a case may be. So that will have to be excluded since we are taking the total profit or losses for a given accounting period. That will have to be excluded. Then in addition, I also have to give effect to the changes in current assets and current liability to ascertain my cash generated from operating activity. And then the taxes, whatever I have to pay as a presentation disclosure, I need to show that as a separate line item. To ascertain my net cash from operating activity. For an investing or a financing activity, so there is no direct and indirect method. We simply follow a direct method wherein whatever cash I would have received, whatever cash I would have paid in relation to that particular activity, I will group that. And if at all I have any tax payment, that will be shown as a separate line item to arrive at net cash from investing activity, net cash from financing activity. Okay. So once I have a net cash from investing activity and a net cash from financing activity, what we basically do is for that, we add opening cash and cash equivalent. Okay. And this would invariably have to give me closing cash and cash equivalent, which has to match with the cash and cash equivalent figures, what I would have presented in my balance sheet. will have to be presented. This will have to match with those numbers. This will have to match with those numbers. Okay. So on the presentation of the cash flow statement, I'll have to group the various activity into operating activity, investing activity, financing activity. What I get is sum total of cash generated from operating, investing, and financing activity. For that, if I had my opening cash and cash equivalent, I will invariably get my closing cash and cash equivalent, and that will invariably have to match. With my figures presented in the balance sheet. Okay, there are a few other topics which I'll cover, and then I'll come toward the end wherein I'll even say what are some of the non-compliances which Institute has notified, or even the NAFRA has notified and pointed out over a period of time. So we'll cover the non-compliances a little later because I still have few more points to cover. Coming to the next interesting thing, coming to foreign exchange transaction. Okay. There is a additional requirement in relation to foreign exchange transaction. The standard says that in case your opening cash and cash equivalent or a closing cash and cash equivalent as a forex item, so that means the price which is subject to change because of change in value. If at all you have any such item in the opening and a closing cash and cash equivalent, let us take a very simple example. I had a USD 1000 USD at the beginning of the financial year when the exchange rate was say 80, and this is opening balance of my USD, and I did not do anything. So the same USD, I have a closing balance when the exchange rate has become say 85. Exchange rate has become 85. Okay. In the balance sheet, so please note that your opening in the balance sheet, you would have invariably presented the foreign currency at say 80,000. Now the same would have become 85,000. So please note that this 5,000 is basically a gain on account of a fluctuation in foreign currency. Okay. Given other items of content, if you were to have prepared a cash flow statement taking a opening cash and cash equivalent, which is 80,000, and added various cash flows generated during the year, so invariably you would have got a difference of 5,000, which is basically on account of a fluctuation in foreign currency, or a gain on account of a foreign currency thing. This gain is a non-cash item. So yes or no, this is a non-cash item. This is actually only when I encash, that is the time when I will be reaping the benefit. Otherwise, it's a non-cash gain. So what the standard expects you to do, the standard says that whenever you have a gain or loss in relation to the cash and cash equivalent, foreign exchange gain or loss in relation to cash and cash equivalent, the gain or loss will have to be shown as a reconciling item to ensure that your cash and cash equivalent matches. So presuming that my opening cash and cash equivalents are so much, and now invariably my closing cash and cash equivalent has become 85,000. So it has to be presented as an adjustment. So what it says is it has to be presented by way of an adjustment. The gain on account of so this will have to be shown as a presentation. So that is how your opening cash and cash equivalent matches with your closing cash and cash equivalent. Okay, let me summarize this again. Whenever you have a foreign currency thing, whenever you have a foreign currency items, so you exclude those which are like gain or a loss, especially in relation to cash and cash equivalent. If you have any such item which has resulted in a gain or a loss, to ensure that those cash opening cash and cash equivalent matches with the closing cash and cash equivalent, ideally I would have excluded the non-cash item. I would have excluded the non-cash item because non-cash item will not find its place in the cash flow statement. Accordingly, to reconcile my opening cash and cash equivalent, I need to adjust the gain or loss in relation to that item and present it as a reconciling item so that my opening cash and cash equivalent matches with my closing cash and cash equivalent. Matches with my closing cash and cash equivalent. Okay, so this is basically as a presentation to ensure that your cash and cash equivalents would match. Otherwise, my would have been 80,000, suddenly it becomes 85,000, which becomes unreconciled or unexplained. If you present that as a reconciling item so that the readers of the financial statements understand it very clearly. Again, while preparing a cash flow statement, following things would not be considered. Non-cash items. Non-cash items. What are the examples of non-cash items? I have allotted equity during the year and I have acquired a property, plant and equipment. I have allotted equity. I have acquired a property, plant and equipment worth 10 lakhs by allotting equity shares to them. Okay, it's a non-cash item, so it is not going to get reflected. But don't you think this non-cash item, if I don't capture it as a, then the readers of the financial statement may not be able to get a complete meaning. So that is why, so these non-cash items, which are significant non-cash items in relation to operating, investing and financing, will have to be presented as a part of your disclosure. Will have to be presented as a part of a disclosure so that the readers of the financial statements understand its implications properly. Okay, so the first thing what we'll have to remember is the non-cash items will not find its place in the cash flow statement. However, if it is significant, then the implications of it will have to be explained by way of a disclosure in notes to the cash flow statement. Then, if there are any movement between cash and cash equivalents, okay. So say in a simple words, I have withdrawn cash from the bank or I have deposited cash to the bank. So these are basically cash management techniques of the management. So those invariably will not be shown as a part of, not be shown in your cash flow statement, will not be shown as a cash flow, will not be reflected in your cash flow statement. The other thing is the common question which we all have is, can I present items in cash flow on a net basis? Can I present an items in my cash flow statement? Can I present it on a net basis instead of a gross basis? This is where most of us go wrong, even presentation wise. That means, say I have sold a property, plant and equipment of 8 lakhs and I purchased a new property, plant and equipment for 10 lakhs. So both a cash transaction. I have sold PPE for 8 lakhs and I have purchased property, plant and equipment for 10 lakhs. So when I say net, can I say net outflow on account of a investing activity? Can I show net outflow on account of an investing activity as 2 lakhs? The answer is no. You cannot present it on a net basis. It has to be invariably presented on a gross basis. So when can I basically do this? When can I basically do this on a net basis? Very, very rarely, okay, very rarely you will have an opportunity to present it on a net basis. Let us understand this. When the receipts and payments, only under these two circumstances, you can follow a net basis. Otherwise, you will invariably have to present it on a gross basis. When the cash receipts and payments are not yours, but you are actually receiving and making a payment on behalf of your customers. So this basically you will see it in bank and financial institutions, or an investment company, okay, where they are taking the money and accepting a deposit and also extending a loan. So since these are the transaction on behalf of a customer, not of the entity itself, this typically reflects the activities of a customer, not for me. I've collected on behalf of a customer and then I have paid it to someone else. So this is basically the activities of customer, not of mine. So in that case, the standard permits you to present those items on a net basis. The second thing is when the receipt and payments are for items where the turnover is quick, amounts are large, and maturities are short. So basically, banks and financial institutions would experience this. For them, they could present this on a net basis rather than a gross basis. So in general, presentation of a cash flow statement on a net basis is not allowed. Only under stringent requirement, you could present the cash flow statements on a net basis. So especially the standard gives you the two possibilities where you could present it on a net basis. Okay, have I missed out? Yes, there are two additional requirements of this standard, one was basically unrealized foreign exchange gain or a loss. The other thing is basically para 40 of Ind AS 7T. Para 40 of Ind AS 7, which has a very interesting implication when it comes to presentation. What it says, para 40 of Ind AS 7, what it says that if a holding company has made an investment in a subsidiary, yes or no? If it makes an investment in a subsidiary, if there is a change in the investment, but the holding is not losing control, okay, then the presentation of that would be slightly different. So this requires an explanation. Let me explain this in a more simple manner. When can one entity gets control over its another entity? In ideal circumstances, when it holds more than 50% of the share capital, that is when one entity is said to have control over another entity. Okay. Now the question is, let us take a situation. A holding company has invested, say, 60 lakhs and acquired 60% stake in another company. The other company became a subsidiary of mine. No problem. How it has to be shown in my cash flow statement? I will show 60 lakh as my investing activity, and accordingly cash flow statement would be prepared. Continue the same thing in the same financial year or subsequently, I acquired additional 20% by paying additional 20 lakhs. Okay. Ideally, what it would look like is, it would still look like I have acquired additional 20%. So it is an investing activity. But as per the requirement of para 40 of Ind AS 7, what it says is there any change? Are you gaining a control or are you losing a control? So there is no change in control per se. You had a control earlier Earlier also you had a control because you had more than 50%. Now also you have a control. You did not lose a control. So there is no impact on the control of the holding company over its subsidiary. And accordingly, what it says is the 20 lakh new investment, what you have made, you don't consider it as a part of your investing activity. You consider it as a part of your financing activity. Okay. So that means you have extended a loan kind of a thing for them. So that is how it has to be analyzed. So let me say this again. Whenever a control gets established, till the time a holding company establishes a control, okay, so that will be grouped or presented as a part of your investing activity. So you have invested, and that is how it has to be presented. Post that, if you further do an investment or withdraw, but it is not giving changes to the control, you still retain the control, you still are an holding company and the other entity is a subsidiary of yours, then that may not have to be presented as an investing activity. That could be taken as a financing activity, and accordingly that would be presented as a loan extended. Okay, so this is in relation to para 40, wherein there is an additional investment being made, but without impacting the control over my subsidiary, then the additional investing activity will be grouped as a financing thing. Coming to, okay, the disclosures. So let us spend some time with respect to the disclosure. We spent initially good amount of time understanding cash and cash equivalent. Okay. The way you ascertain cash and cash equivalents, invariably, as per the requirement of Ind AS 7 only, you will be doing it. If at all you are changing the cash and cash component understanding, or if at all you are changing the methodology, then that would be treated as a change in accounting policy. That means Ind AS 8 will come into picture, and one have to be very, very careful. So what is the accounting policy, or how we have ascertained your cash and cash equivalent? That will have to be explained in detail. The component of a cash and cash equivalent will have to be explained in detail. And if at all there is a change in the component of a cash and cash equivalent, management has decided to change the component of a cash and cash equivalent, then that will be taken as a change in accounting policy, and the implications or the impact of Ind AS 8 would get attracted. A reconciliation of a cash and cash equivalent. You have to present something called as a reconciliation of a cash and cash equivalent. Say, for example, there is a line item. There is one line item of 60 lakhs, which you would have said that as cash and cash equivalent. You will have to invariably explain what are the components of this 60 lakhs. What are the components of this 60 lakhs? So this is your opening balance, and your closing balance becomes, say, 80 lakhs. So you'll have to invariably provide a reconciliation as to what were the components of this cash and cash equivalent. The components could be cash, your deposits, short-term deposits, etc., bills receivable, those kind of a thing. Okay, and how the movement has happened from opening to closing balance. So this reconciliation of cash and cash equivalent will have to be presented as a disclosure of this standard, as a disclosure to this standard. We said, while preparing a cash flow statement, we don't take into account the non-cash items. However, if there are any significant non-cash items, if there are significant non-cash investing or a financing activity, I took an example wherein we acquired a property, plant and equipment by allotting equity shares. So nowhere it will have appearance in the cash flow statement. But those significant non-cash investing and financing activity will have to be explained as a part of your disclosure requirement, will have to be explained as a part of your disclosure requirement. Okay. The other disclosure is changes in liability arising in financing activity. Very interesting. When I prepared my cash flow statement as a cash flow statement, I would have prepared net cash flow from my financing activity. Say, for example, let me again take the same example. I have a opening borrowings of say 60 lakhs and the closing borrowings has become 80 lakhs. Okay. Now, I would have this movement would have been happened either on account of an interest accrual, which I am not paid, okay, or because of some penal provisions which I have not paid during the year. So ideally, this might not come as a part of my cash flow statement at all. That is where, and the readers of the financial statement may not understand if they look at the financing activity in the cash flow statement, they may not able to get a complete picture as to how the movement has happened from opening to the closing balance in relation to the liability. So that is where the standard expect you to prepare a reconciliation taking into account both the cash and the non-cash movement, both the cash and the non-cash movement in relation to a liability, okay, and then present it as a part of a disclosure requirement. Let me repeat this again. Your cash flow statement, your financing activity group in the cash flow statement might not be a self-explanatory for the readers of the financial statement. In the given example, there was an outstanding loan of 60 lakhs and it has become 80 lakhs. And nowhere since it has happened, it could have happened. We took an hypothetical example of interest accrual and some other penal implications. That is how the 60 lakh has become 80 lakhs. It might not find its place in the cash flow statement because there was no cash movement, cash inflow or an outflow. But readers might not able to get a complete picture. That is where the standard expect you to prepare a reconciliation, taking into account even the non-cash movements, which has led to shift from opening balance to the closing balance. So the standard expect you to prepare a reconciliation explaining the changes in liability in relation to your financing activity. Last but not the least, restriction on cash and cash equivalents. Restriction on cash and cash equivalents. I may have a cash equivalent. Say, for example, I have a dividend declared which I need to pay, pending to be paid. Okay, so you know that has to be paid within a period of 30 days. Same with respect to share application money received pending allotment. If I don't do an allotment, I may have to return the money within a 30 days span. So share application money received pending allotment. Another simple example could be I have parked the money in a trust account. So basically, which is subject to restriction. So those kind of a thing will have to be, even though it is forming part of my cash and cash equivalent, I need to present those restrictions separately as an explanation to the readers of financial statements. I'll have to say whether the cash and cash equivalents have any restrictions attached to it, and those presentations will have to be shown separately. Okay, let us have a quick revision of what we have discussed till now, and then we'll move on to some of the mistakes what the institute has identified over a period of time. What are the mistakes we tend to do in a presentation of cash flow statement? Okay, so we started understanding as to the cash flow statement, how the cash flow statements are different from the fund flow. Fund flow basically is a more generalized thing which takes into account the movement of current assets and current liability, where in addition to cash, even the accruals are accounted to arrive at the movement, to know the movement of fund. However, cash accounting takes into account the actual movement in cash. Having said that, it will invariably exclude non-cash items, and it will also not take into account movement within the cash and cash equivalent for presentation. Okay, so then we went on to discuss cash and cash equivalents. Cash and cash equivalents are those short-term, highly liquid investments which can be converted to known amount of cash, which is subject to insignificant risk of change in value. So the definition would almost similar to Accounting Standard 3. The new requirement what we have is, when it comes to Accounting Standard Ind AS 7, it has a para which clearly says that the cash and cash equivalents are to meet short-term cash commitments. It has to be for meeting the entity's short-term commitments. That is when this will become a cash and cash equivalent. Once we understood cash and cash equivalents, we went on to see what are operating activity, what are investing activity, what are financing activity. Okay, operating activity are a principal revenue generating activity, and in addition, a residual in nature. If I'm not able to group an item into investing or a financing, that will find place in operating activity. What are investing activity? All that movement which could happen in non-current assets criteria category, those will be grouped and presented as a non-cash item. All that movement which could happen in equity and non-current liability, we group that as a forming part of my financing activity. And any such item in relation to that will have to be segregated and presented in cash flow statement. While preparing a cash flow statement, I can follow a direct method or an indirect method. This direct or an indirect method is there only for operating activity, not there for investing and financing. In a direct method, we call it as a top-down approach. I will start analyzing the total cash received from my operating activity, from a revenue generating activity, total cash spent in relation to revenue generating activity, and then I arrive at my net cash flow from operating activity. If it were to be an indirect method, I follow a bottom-up approach wherein I start with the net profit or loss, adjust for non-operating items, adjust for non-cash items, and then I even adjust for my changes in current assets and changes in current liability to arrive at net cash from operating activity. Coming to the taxes, the standard makes it very clear. Taxes, if you are in a position to bifurcate between operating, investing, and financing, you can present that as a separate line item under each of the respective grouping. However, toward the end, you have to give a sum total of the tax outflow happened during the year. If you're not able to bifurcate, then you can show that as a separate line item under operating activity. Will have to be shown. In either of the situation, tax flow will have to be shown as a separate line item in the cash flow statement. Okay, so then we moved on to understand in case of a unrealized gain or loss for an item appearing in unrealized gain or loss for an item appearing in cash and cash equivalent, the same have to be presented. The gain or loss will have to be presented separately as a reconciling item so that my opening cash and cash equivalent matches with my closing cash and cash equivalent. Then we moved on to para 40, wherein it says that if a holding company makes an investment, that invariably is a investing activity, but post that, if there is any movement which happens, which does not alter the control what holding company is having, then that might not be shown as an investing, that could be shown as a financing activity. Okay, And then we discussed about disclosure. One disclosure is the major disclosure would be the components of your cash flow. How have you ascertained the cash and cash equivalent, and also a reconciliation of opening cash and cash equivalent with the closing cash and cash equivalent. We normally exclude non-cash items. Significant non-cash investing or financing activity, if it is excluded, that will have to be shown as a disclosure so that the readers of the financial statements understand it properly. Then changes in liability arising in financing activity. Basically, the financing group under the cash flow statement might not give a complete picture. The standard expects, for the benefit of the readers of the financial statement, that you prepare a reconciliation providing for movement in the liability in relation to your financing activity. If at all you have a restriction in relation to cash and cash equivalent, those restrictions will also have to be covered. Okay. So I was also asked to spend some time with respect to differences in AS3 compared to Ind AS 7. Okay. So in AS3, we had a possibility of extraordinary item. Extraordinary item. If at all you had an extraordinary item, the standard expected you to present that line item separately, either in operating, investing, or financing. That requirement is not there in Ind AS 7. Okay. Coming to bank borrowings, this is one thing which could be overdraft or a cash credit, As per accounting standard 3, the bank borrowings, I would have grouped it as a financing activity. Invariably, I would have grouped it as a financing activity. Okay, I would have grouped it as a financing activity. However, in Ind AS 7, overdraft could take the color of an operating. Overdraft could become a part of your cash and cash equivalent, or part of your operating activity, provided if this is for a short duration and management intention is to maintain or manage its cash position. And most importantly, if you look at the overdraft, it is surplus, and only when there is a requirement, it is overdrawn, and again it is refilled so that it come back to surplus position. So overdraft could take the nature of a cash and cash equivalent, but cash credit invariably remain as a part of your financing activity. Okay. Then the lease. Okay. The lease payment or a lease receipt in the books of a lessee or a lessor. Okay. Lessor would might remain same because the accounting for a lessor, even in Ind AS, is almost similar. However, accounting for lessee has undergone a change, and accordingly, the lessee will invariably have to follow only the financial lease for accounting, and accordingly you will have to recognize a lease liability, and any lease payment what he makes would be deemed to be the payment in relation to lease liability, and accordingly this might be presented as a financing activity. This might be presented as part of your financing activity. Okay. In accounting standard regime, the lessee will evaluate whether it's an operating lease or a financing lease, and accordingly, you will show that as an lease payments could be shown either as an operating activity or a financing activity. We have an additional requirement of Ind AS para 40, which we said, wherein if there is no change in control, okay, the additional investment which the holding company makes to the subsidiary could be categorized as a financing activity in Ind AS regime. This requirement is there in Ind AS regime, where if there is a additional investment over and above what it has made to acquire a control, that additional investment could be categorized as a part of your financing activity, but there is no such specific requirement. There is no such specific requirement when it comes to Accounting Standard 3. Last but not the least, the disclosure. The disclosure is more detailed in Ind AS compared to Accounting Standard 3, especially with respect to okay. Yeah. So we have additional requirement with respect to like changes in liability arising in financing activity. Yes.
Yes, first I have a few questions from your session. Shall I ask you?
Yes.
Yeah. My first question is, how detailed should reconciliation of cash and cash equivalent be, especially when there are restricted cash balance?
Okay. There are two components to this question. One is reconciliation. Okay. So if your cash and cash equivalent has three components, okay, you need to provide a reconciliation as to what was the opening balance and how did you reach the closing balance. So that reconciliation you'll have to make. In one of the components, if you still have a restriction on usage, that will be presented as a disclosure. That will have to be presented as a disclosure. Say you have a cash balance. Okay, let me make it. You have a cash, you have a say bank balance, you have a short-term EFDs, etc. So you will have to start with what was your opening balance and then what was the movement, and then you will have to arrive at a closing balance. So this is a reconciliation. In addition, if your bank balance has a restriction, okay, restricted cash and cash equivalent, those will have to be presented as a disclosure for readers of the financial statement to understand. That could be like a balance containing a share application money pending allotment, those kind of a thing, what you will have to do. Or it is held under a trust account, those kind of a disclosure might have to be provided.
Okay. My second question is, can dividends received ever be shown under the financial activity, or are they always classified under investing activity?
Okay. The question is, when you will receive a dividend? When you will receive a dividend?
Okay.
You receive a dividend if you have investments elsewhere. Correct. No, if you have made an investment in another entity, that is when you will get a dividend. Let us understand the receipt and payment separately. You will, if you are receiving a dividend, that is because you have invested. Okay. Because of your investment, you are getting a dividend. So accordingly, this will be considered as your investing activity. However, this is a receipt.
Okay. The next question is, what are the disclosure requirements when entity use different accounting policies for classification of cash flow within a group?
Okay. So this is in relation to the consolidated financial statements. What happens is, this is again an interesting thing. When you're preparing a consolidated financial statements, even there you're supposed to prepare a cash flow statement. You're supposed to prepare a cash flow statement. There, my disclosure would be in comparison to the last year, were there any change in the cash and cash components of the current year? So that I'll have to evaluate from a group entity perspective, not from the individual entity perspective. For the group as a whole, how was the cash and cash components were ascertained at the beginning of the year or in the last year? Were there any change to that? If at all there is a change, then that explanation will have to be given.
Okay, next question is what level of disclosure is expected when significant non-cash transaction occur, like conversion of debt to equity?
Yes, debt. See, cash flow statement, while preparing a cash flow statement, we might have excluded non-cash items. But our objective, please understand the objective of preparing a financial statement, the main objective of a financial statement is the readers should be able to get a complete picture of the financial position and financial performance. So non-cash items having been not disclosed in the cash flow statement, if I present it as it is, then the readers might not able to understand it correctly. So that is where the standard has made such disclosures mandatory, wherein whenever there are significant investing, financing, non-cash activity happens, then that will have to be elaborated and disclosed in detail so that the readers understand its impact properly.
Okay, the next question is how to disclose cash flows related to supply chain financing in cash flow statement.
Could you make it more? Okay, is
Okay.
that
Related to supply chain financing
okay?
in the cash flow statement.
So now the question comes: are we in a position to present this on a net basis? So that is where can we present the cash flow statement on a net basis? This might be the starting point or for us to understand. So whenever in a supply chain, basically most of the transactions I might be doing it on behalf of my customers. Those transactions might not be for myself, but it might be on behalf of my customers. So then I may be in a position to present the cash flow statements on a net position for especially for those transactions which I have received funds and paid funds on behalf of my customers. So that might be presented on a net basis. So presenting cash flow statements on a net basis could be relevant in this kind of a situation.
Okay, my last question is if a temporary advance given to the site management to meet existency, should it be part of cash or cash equivalent or other financial asset?
What is the objective of extending the temporary financial thing? Is it to mitigate, is it to manage entities' financial position, or is it to manage the third party's financial position? Will give an answer. If it is a manage entity's financial position, then yes, then it could be classified as a cash and cash equivalent. In the given instances, it looks like more to support the support staff rather than for entity's financial position. In this case, it may not be falling under cash and cash equivalents.
Okay, if anybody have any query, may ask. I think there is no query, no more question is left. Okay, I would like to say thanks to our speaker, CA Kaleshwar Prasad sir, and the whole team of ICAI and all the participants. I hope after this session, they will increase their knowledge related to the cash flow statement. Thank you, sir. Thank you, whole team of ICAI, arranging this webinar. Thank you, sir.
Thank you. Thanks to each one of you. Thanks for this time. Have a wonderful time ahead. Thank you.
Thank you, sir.
Yes, Ankit, you can end the session.
Thank you.
Thank you.